Great. Well, I'm David Townsend. I'm a PhD at the University of Oklahoma and currently serve as an assistant professor of entrepreneurship at Virginia Tech in Blacksburg, Virginia. Been there for a year and spent the previous 5 years at North Carolina State. Yeah, so my primary motivation for working on this research was to really disentangle the question of what drives the investment cycles into early stage technology ventures. And there's a pretty significant debate, I think, started really on the practitioner side, where a lot of early prominent VCs and others would talk about the role or the importance of the management team in driving their investment decision making. But in the research literature, as we've sort of explored the question, I think that there's been some discrepancies between what practitioners think they're doing and what we're actually sort of testing as we deconstruct their decision processes. And so there's been a lot of work done with conjoint analysis to look at these decisions, and I think it's really shown that maybe markets or the technology or other factors make a big difference. There's also a stream emerging in the finance literature that's starting to sort of criticize this management-centric view. And there's this Jockey and the Horse paper that came out with Steve Kaplan, and some of his colleagues that looked at the role of the management team versus what they sort of talked about or called the business idea. And so we were intrigued to really look at this in the context of an early stage or set of early stage technology ventures. And so to take it sort of out of this experimental conjoint analysis to actually into the field to see if we could really deconstruct the elements. We call them the three main ingredients, if you will, the management, market, and the technology. Deconstruct exactly what recipes, if you will, do investors look at when they make their early stage investment decisions, but not just what do they say they're going to do, but what do they actually do? So how do these different combinations actually affect the flow of capital into the firm? So the research process for us is we had a relationship with an organization that actually worked with. So in Oklahoma, there's an organization that works with about 90% of the technology startups that emerge within the state, and they've been working with them for about 15 years now. And so pretty much every year they just kind of have a cycle of ventures that work through. It's a little bit different process with them because they're not a technology incubator. And they, at this stage when we did the research, they actually did not have any type of early stage financing besides the seed capital fund that they would do on a sort of a loan basis. And so they would have this small loan that would be matched by private capital. And then, at some point when the firm hit milestones, they would have to pay back this loan. And usually it was just a couple $100,000 on the loan front, but they didn't do any type of early stage investments. They really just were a service organization set up as a not-for-profit that was there to help technology ventures get started. And so we built a relationship with them over a few years. And through that process, they expressed interest in us doing research with them because they were really trying to scrutinize what kind of practices they did and what kind of impact that they were having. And from our end, we looked at the type of data that they were collecting. We always would joke around that they were sort of a research group without the theory and without maybe some of the methods training that we had. But they were very rigorous about collecting data. And as we sort of explored the data set and really started to match that with the type of questions that we were interested in asking, there was really a nice common ground to look at the factors that drove the early stage capitalization process. And so what we did was really start with a group of technology ventures. We have longitudinal data that looks at these ventures over a pretty extensive period of time. Now, of course, a lot of these ventures are starting and then going out of business or are sort of the zombie companies, the Walking Dead, because they don't necessarily have any, and they're not able to raise money. They don't have any real opportunity to move forward, no resources to move forward. But many of them, we captured them before they even incorporated with the state, where it really was just a concept or maybe an idea that the founder or group of founders had in their minds. And so we were able to sort of track it from really the inception of the idea through the startup process, through multiple rounds of trying to raise financing, and really was able to track the growth of the firm. And so we decided to focus on the early stage capitalization process, mostly because there you really start to get a sense of the factors that are driving investment decision making, where there's not necessarily a huge track record yet. And I think once you start to throw cash flows into the mix and market traction, then some ideas that maybe not necessarily as high profile could get the attention of investors versus other ones that are potentially more have higher long-term potential, but don't necessarily have the traction yet. And so really tried to isolate it on that early stage process. And so pretty much any firm that had not broken even yet in terms of their cash flows, their net income, we included within that mix, just following the National Venture Capital Association guidelines on stages of capital. And so we looked at pretty much anything that they raised from the three major types of investors. And so it could be early stage venture financing, angel investing, or strategic financing from corporate investors. There's really not a formal corporate venture capital arm within the state of Oklahoma, but these would be, there's a lot of oil and gas companies. There's actually a pretty high, pretty growing sector of biotech companies. So different research foundations and others. And so kind of looked at the mix there. So we controlled for the types of financing that the firms raised. What was fascinating to us is that I know Scott Shane had some work on angel financing and was sort of critiquing the idea that angel investors and VCs were co-investing in different deals. In our perspective, we saw lots of co-investment, and we saw investors strongly prefer to co-invest. They very much wanted to have other people, other types of investors in the mix. And maybe some of that has to do with some differences with the Oklahoma, versus maybe a very much more mature place like Silicon Valley or Boston or one of the major tech clusters. We saw lots of co-investment, and so we really just look at the factors that would explain that. And so the measures were developed through a couple different processes. And so we had management team scores. Now, we could have gone the traditional route with the management team scores, looking at background characteristics of the founder, CEO, industry experience, education, those type of things. And we had the data coded. But what was unique about this relationship we had with our data source is they actually go through a very extensive due diligence process that like a venture capital organization would go through. And so they had a very extensive analysis done of the management team, interviews. They would interview founders, other founders that had relationships with them. They had interview other individuals who had worked with these people before. Just went through this very, very extensive process to really get to know who these management team members were, what kind of capabilities and skills that they had. And they had a set of measures that they would use to actually evaluate the teams, and they developed this composite score. And the more we talked about it, and the more we looked at the score, we're like, we just never going to be able to replicate this. And plus, there's always a problem of retrospective bias, where we would know kind of what the quality of the management team was, and their experiences or success in growing the venture would sort of color the extent to which we sort of saw them as successful or capable or not. So these scores were done right at the beginning, before a lot of these founders had ever gotten started with the venture. And so it was really timed perfectly with the type of research question that we were asking. So we used their measure actually for that, and then went through a process of trying to validate that measure and then compare it really with what we traditionally have used in other types of research. We also looked at this sort of extent to which the technology itself was a radical innovation. And on this front, the organization actually had this very extensive due diligence report around the technology in the market that was produced by this outside organization. And so they would pay about $1,000 for each one of these reports. It was proprietary, so it was nothing we could share, but they shared it with us. And so it would be something that where this organization would go out and interview people, other founders and companies within that space, or other large companies, to get a sense of what's happening with the technological, the trajectory of technological change in that space, and then would also look at what's happening within the market, and would compile this really, really rich report. And so we used a couple different coders to content analyze those reports, just using some standard measures that have emerged in the various literatures that explore radical innovation or demand uncertainty. And so we measured those two variables specifically. And so we really just tried to look at the extent to which the management team and the capabilities of that management team would interact with the amount of technological risk or radical innovation within the firm versus the amount of demand uncertainty. And so how early stage with this market, to really get at ultimately the fundamental question of this idea of that, management teams matter. And the way that we talk about them mattering reflects this idea that they have these dynamic capabilities, that they're able to really kind of find the right opportunity in the market. And they can always adapt or adjust or tweak things within the firm to make it work, to find the right ingredients. And you sort of contrast that with there's this perspective we open with one of the quotes. It says, even the most competent management team can't turn water into wine. And so it's really this sort of trade-off is how much agency does the management team actually have in the eyes of the investor? And to to sort of change or adapt or adjust. And so if you have a great management team, but it's really capped by a really radical, uncertain technology in a market where there's just massive amounts of demand uncertainty, are the investors really fundamentally willing to bet on that management team, given that the other parameters are really going to make it difficult for them to assess? And so to that end, we basically find that the management team matters, and so higher quality management teams was positively related to higher amounts of capital invested in the firm, and we control for the amount of money that the firm is trying to raise, and a lot of other alternative explanations. But when we started to look at the interactions, that's where I think we found some really interesting things, in that it really boiled down to the quality of the management team, but the extent to which the technology was very radical, or the amount of demand uncertainty really strongly impacted the effectiveness or the extent to which the quality of the management team impacted the amount of money that flowed into the organization. And maybe not surprisingly in hindsight, but really the demand uncertainty question was huge. And so I think it really kind of boils down to that investors, they obviously love to invest in things with big markets, and they're willing to gamble on lots of different things if they can find something that potentially has a huge market where there's pretty clear demand for a product or service. And I think practically that has some pretty important implications for how we sort of evaluate or construct ventures and how we actually approach this question of how to build an early stage organization. What kind of resources and people do you need? In terms of implications of this research for the various different groups, I think there are implications for the support organization, for investors, and for the entrepreneur. For the support organization, what was really interesting is, even though it was just a control variable or set of control variables, we controlled for the type of services that they provided to these organizations. And what we basically found is that for every dollar that they provided with a loan, they were actually able to turn that into $22 in private capital during these early stages of financing. And I think it really kind of goes down to this question of, and especially in the United States, there's this massive debate about, to what extent do we want different government agencies or other groups supporting entrepreneurship. And this was a nonprofit, but it was actually under the Oklahoma Department of Commerce. And so the organization itself was funded through state dollars, and those dollars were having a huge impact on helping these organizations raise money. And it's sort of this question. We look at this idea of social proof with investors, of whether or not VC is going to invest is strongly influenced by whether or not they see their friends or competitors investing. And it's really hard to get the first person to say yes. But once you do, there's almost like this cascade of dollars that flow into the firm. And so you've kind of got to get the process started somewhere. And so to that end, I think these organizations can help tremendously, helping these startup ventures really get traction and gain credibility, gain legitimacy. And so it's almost like legitimacy by proxy, that they would endorse the organization, they would link them in with their investor network, and then that would have a huge impact on the success of that venture and raising financing. And so it's good to work with people, as a startup, that have those type of connections. And I think for investors, there's this idea that they sort of talk about the importance of the management team, and you listen to them sort of discuss. And so I think for investors, it's important for them to understand what they're actually investing in and what really sort of driving their process, because they may pass up on really fantastic deals because they think that some of the ingredients that matter to them don't actually matter. And so this process of being able to find and select great deals potentially out in the environment, I think it's critically important for them to understand their decision process in much more detail. Because again, I think from an unsolicited business plan or business model canvas or whatever, the actual or pitch deck or whatever is turned in, I think most of the research shows that they only spend about 90 seconds or less evaluating that. And so those sort of ingrained heuristics, if you will, are driving their process. And so I think for a lot of them, they need to understand that. And so instead of pouring capital into the same deals and maybe over liquidating some ventures and then starving other companies because they think they know, they understand what their decision criteria are. I think that's critically important to understand. Management teams matter, but they're really driving, the driving emphasis for them is really the technology and the market. And so in terms of how they source deals and how they evaluate deals and construct their own due diligence process, I think it's critically important. And then I think, but most importantly, and from my perspective, being an entrepreneurship scholar and very much an advocate for entrepreneurs, I think from my perspective, it's how do you go about constructing the venture? And there's that massive debate about founder replacement, and when should you be willing to give up the reins, or what role should the founder versus a professional manager play? And I think that's what sort of was driving some of our conclusions. Is it seems like investors do like management teams, but maybe not for the reasons that we sort of expect. And so we speculate at the end about this idea of this sort of symbolic side of the managers themselves, and so what their background characteristics and all that. So not based on track record, but based on, does the investor think I can sort of sell this venture down the road to other professional investors? And so does this entrepreneur check off the right boxes? So I think understanding that is important for the entrepreneurs, because bringing on a high-profile, high-powered manager to help run an organization is a pretty expensive proposition. I mean, they're going to require quite a bit of cash, require quite a bit of equity, control, and so the founder is really going to have to give up a lot to get one of these individuals, or if even being completely replaced by an investor. And so to what extent do you bring these individuals on, for sure. But then also I think, pragmatically, for an entrepreneur, if you want to create a venture that's going to have a high probability of being successful, I think having clarity around the type of market you're going after and the type of technology that you're going to pursue is critically important. And so if the goal is to try to construct something to raise money, I think certainly that has a big implication. From my perspective, I always sort of prefer to work alongside of ventures that are much more interested in long-term value creation than just trying to early stage sort of hack the financing process to raise financing. But certainly I think there's implications on both those points for entrepreneurs.